Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Izian Amatullah binti Omar Bakri. My matric number 264651. Today I will continue about the lesson theory or framework that related with this case. First is the mutual reward theory or MRT that state a relationship between two parties is enhanced when there is a satisfactory balance of rewards between them. In a good MRT relationship, both parties come out ahead. This theory basically states that people attracted to those who identify with rewarding situations. In other words, individuals are attracted to folks who make them feel good or who remind them of people that they enjoy with receiving the reward. For example, in working relationship, if working relationship is to remain healthy over a long time, it must contribute something of value to both person. When one individual suddenly discovers that she or he has been contributing substantially more than she has been receiving, the relationship can quickly weaken. However, when there is a balanced reward system between people, the working relationship can thrive. In case of a relationship, if a relationship offer more reward and pleasure than cost and pain, that the relationship is more likely to be long last. Same goes to our daily routine in making some transaction. Anything that comes with something that people think it is a reward, it will give positive view to the person. For example, if you are a loyal customer for a brand and they recognize your loyalty by rewarding you maybe with discounts or free items or whatever that they feel are rewarding, so it will lead the customer to continue involving in that brand, which leads to profit for the company in future. Next is conceptual framework for financial reporting. This framework is a basic document that sets the objective and the concept for general purpose financial reporting. This framework also for the preparation and presentation of financial statement and was published in 1989. Then, in 2010, the IASB released a new document which is Conceptual Framework for Financial Reporting, but it was incomplete as a few concepts and chapters were missing. The most recent and complete framework published in 2018 consists of 8 chapters, which are the objective, qualitative characteristic, financial statements and the reporting entity, the element of financial statements, recognition and derecognition, measurement, presentation and disclosure, and concept of capital and capital maintenance. In this case, it's related with the chapter recognition and derecognition. Simply put, recognition is the inclusion of a financial statements element in the financial statements. In other words, if you decide on recognition, you also determine whether or not to include this item in your financial statements. The framework requires items to be recognized only when they give meaningful information relevant with faithful representation. The framework then goes into detail on the framework's relevance, faithful representation, cost constraints, and other elements. For example, that we can see is revenue recognition. The principle of revenue recognition states that a person should only record revenue when it has been earned, not when the relevant cash is collected. For example, a company have complete their service to customer, so the company should be recognize it as income. If the customer pays in advance but the service has not been delivered, it will not be considered as a revenue because of the service has not been performed. Besides that, the next framework is International Financial Reporting Standard (IFRS). IFRS is a collection of accounting regulations that regulate how transactions and other accounting events must be recorded in financial statements. They are intended to ensure financial credibility and transparency, allowing investors and business operators to make good financial decisions. The International Accounting Standard Board (IASB) sets and maintains IFRS standards, which were created to establish a common language so that financial statements can be simply interpreted from company to company and country to country. For this case, it's related with IFRS 15, which determines the revenue from contract with customers. IFRS 15 is effective for financial period beginning on or after 1 January 2018 with earlier application permitted. IFRS 15 specifies the standard that our business must follow when reporting information concerning the nature, amount, timing, and uncertainty of revenue and cash flow from a customer contract. In accordance with IFRS 15, a company recognizes revenue to indicate the transfer of promised good or service to the customer in an amount that reflects the consideration to which the entity expects to be entitled in exchange for such goods or services. And the last one is Generally Accepted Accounting Standard, GAAP. GAAP is a set of financial reporting accounting rules and standards that are widely followed. GAAP standards comprise concept and principle definitions as well as industry-specific rules. The goal of GAAP is to ensure that financial reporting is consistent and transparent from one organization to another. GAAP is based on established principles, objective standards and conventions that have evolved through time to guide how financial statements are prepared and presented for all firms. GAAP are also established for companies or non-profit companies with the goal of giving information that is valuable to investors, lenders or others who contribute or may potentially provide resources. Another objective of state and local government financial reporting is to provide information that allows taxpayers and others who utilize governmental financial statements to hold governments responsible. GAAP include 4 principles on which are recognition, measurement, presentation and disclosure. Recognition is what items should be recognized in the financial statement. For example, asset, liability, revenue, and expenses. While measurement is about what amount should be reported for each of the elements included in the financial statement. Next, the presentation is what line items, subtotal, and total should be displayed in the financial statements and how might items be aggregate within the financial statements. And the last one is disclosure. Disclosure is about what specific information is most important to the users of the financial statements. That's all from me. Thank you.